All right, let's dive in today. We're wading into some pretty interesting financial news. We'll be starting with the latest in the U.S.-China trade situation, I guess you could call it. And then after that, we'll see how those tariffs might be hitting tech and auto. And then to wrap things up, we'll take a peek at some earnings reports coming up that have us, well, a little curious, to say the least.
That's like we're going to be uncovering a fascinating network, one where like decisions in one place can have a huge impact across the world.
No kidding. So first up, the tariff battle. We've been keeping a close eye on this, and it seems like things are escalating, to say the least. One of our sources, The Motley Fool, reports that China has hit back against some recent U.S. tariffs with their own tariffs on stuff the U.S. sends over, like coal and natural gas.
Yeah. This kind of tit-for-tat response is a familiar tactic in these trade wars, but history shows us that it usually doesn't end well for anyone. Often both sides end up hurting their own economies and throwing a lot of instability into the global market.
And it's not helping that this is all happening, while the U.S. and China are also trying to work together on border security. How do you make sense of these two seemingly conflicting things going on at the same time?
It just shows how complex international relations can be. Economic interests and political moves get all tangled up, and it's tough to find common ground when everyone has different priorities.
Absolutely. Okay, so let's talk tech now. There's been some buzz that President Trump might be thinking about tariffs on chips and related products. Is this something that could really shake things up in the tech world?
Oh, it definitely has the potential. Companies like Apple, Samsung, Intel, they all rely on global supply chains to make their chips. These tariffs could directly impact how much it costs them to make their products, which could, maybe lead to delays in getting those products out. They might even have to rethink their whole approach to manufacturing.
So it's not just a simple price hike. We could be looking at bigger consequences for consumers down the line. What do you think? Will companies just absorb those costs, or will they pass them along?
That's a tough one to predict. It's probably going to be a mix of both. Companies might try to eat some of the extra costs at first to stay competitive, but eventually some of that burden will probably trickle down to us, the consumers. We could see higher prices on all kinds of stuff: smartphones, laptops, cars, maybe even appliances.
Speaking of cars, let's switch gears to the auto industry. Our sources say that NAFTA, that's the North American Free Trade Agreement, plays a huge role in tying together how the U.S., Mexico, and Canada all make cars. Can you explain how these tariffs could disrupt that whole system?
Well, NAFTA has created this really integrated network in the auto industry. Parts and vehicles move freely between the three countries, but these tariffs could mess with that balance, especially for those big U.S. car companies like Ford, General Motors, and Stellantis.
Yeah, the Motley Fool had an article about General Motors specifically. They make some of their cars in Mexico and Canada, and moving all that production back to the U.S. to avoid the tariffs could cost them over $1 billion just in labor costs.
That's right, and there is an analyst from BNP Paribas who estimated that a 25% tariff on imported cars could cut GM's operating earnings by, get this, like 50%. Moving production back to the U.S., where labor costs are higher, would be, pretty expensive, but it might still be better than dealing with the full force of those tariffs.
Wow, that puts things in perspective. So, tough choices for those car companies. But then there's Tesla. They seem to be in a much better position, right? They've been all about making things locally for a while now.
Yep. Tesla's focus on building factories closer to their customers could give them a real advantage here. Their CFO even said that while they still get parts from different places, they've been working hard to keep their supply chains as local as possible.
And then there's the whole Elon Musk element. His, shall we say, dynamic relationship with President Trump. Some might even call it unpredictable. But it could end up protecting Tesla from some of the fallout of this whole trade war. It'll be fascinating to see how that all plays out.
Absolutely. It definitely adds another layer of complexity to an already very complicated situation. It's a good reminder that personal connections and political maneuvering can sometimes be just as influential as economics when it comes to shaping global trade.
All right, let's move on to a company that seems to be doing pretty well amidst all this market turmoil. Palantir. This data analytics company just blew past earnings forecasts and sent its stock way up. What's behind their success?
Their recent earnings report was really impressive. They exceeded all expectations and showed how strong their commercial division is. They managed to sign something like $803 million in contracts last quarter, which is, a 134% increase compared to the same period last year.
Whoa, that's a huge jump.
Yeah.
And their CEO, Alex Karp, is even predicting even higher revenue than the analysts were expecting. But there's one thing that has us a little puzzled. Palantir's current valuation is over 170 times forward earnings, which seems incredibly high. Can you explain what forward earnings are and why this valuation is so unusual?
Yeah, so forward earnings are basically an educated guess about how much a company will earn in the future. Using them to figure out a company's value helps us get an idea of their growth potential. But a valuation of 170 times forward earnings, that's definitely high, even for a company growing as fast as Palantir. For comparison, the average for the S&P 500 is more like 15 to 20 times forward earnings.
So, should investors be worried? What should someone thinking about investing in Palantir take away from this?
It's definitely something to consider. Now, it could be that early investors are just cashing out after the recent stock surge. That happens a lot when a company beats earnings estimates. But it could also mean that there are some internal concerns about whether the company can keep up that high valuation over time.
So it's a balancing act for investors,
Yeah,
weighing the potential for fast growth against the risk that the valuation might be inflated.
exactly. It highlights the importance of research and due diligence. Never just accept things at face value. Always dig deeper into the numbers and look at things from different angles before you make any investment decisions.
Before we wrap up this part of our deep dive, I want to touch on two big names in the digital world that are about to release their earnings reports: PayPal and Spotify. These companies are major players in today's digital economy, and their reports will give us some valuable insights into how that sector is doing.
I agree. Their performance will be a good indicator of what's happening in the digital landscape overall.
Okay, so let's start with PayPal. We know they're renegotiating contracts with merchants right now, which they're doing to improve their profit margins. I'm curious to see if that affects their growth rate.
Yeah, that'll be something to watch for sure. Growth is important, but it needs to be sustainable. It's good to see that PayPal is focusing on profitability as well as expansion.
And we have Spotify. They just announced record profits last quarter. We'll be paying close attention to their new subscriber retention rates and the details of their new publishing deal with Universal Music Group. Those things can have a big impact on their bottom line.
Absolutely. For streaming services like Spotify, growing their subscriber base and managing how much they spend on content are crucial for their long-term success. The specifics of that Universal Music Group deal will be particularly interesting to analyze.
So we've talked about trade wars, potential problems in the auto industry, the importance of leadership and valuation with Palantir, and we've even gotten a preview of what to watch for in PayPal and Spotify's upcoming earnings reports.
It's a lot to process, but that's how the financial world works. It's constantly in motion with all these interconnected forces shaping the landscape.
Well put. Okay, before we move on, let's have a little fun with a thought experiment. Imagine this. The CEO of either Alphabet, AMD, or Chipotle suddenly steps down. If you could only sell your shares in one of those companies based on this news, which would you choose and why?
That's a tough one. All three companies are doing well and have solid track records, but if I had to pick, I'd probably go with selling Alphabet.
Oh, really? Why is that?
Well, think about it. Alphabet's success has been so closely tied to Larry Page and Sergey Brin, the founders. Their vision and leadership. Sure, Sundar Pichai has been doing a great job as CEO, but it always makes you wonder, what happens when a founder-led company loses that original driving force?
I see what you mean. The founder's personality and ideas, they're kind of woven into the company's culture and the direction they take.
Exactly. With AMD and Chipotle, they have strong CEOs too, Lisa Su and Brian Niccol. But their leadership feels, I don't know, more focused on the day-to-day, on making things run smoothly. But Alphabet, under the founders, was always about pushing the limits, coming up with those groundbreaking ideas in tech.
So you're thinking that, while a CEO change at AMD or Chipotle might not be as big of a deal, a sudden change at the top for Alphabet could really throw them off course.
That's the idea. AMD and Chipotle are like well-oiled machines, right? Consistently delivering what they're known for. Alphabet's more like a rocket ship, always aiming for new frontiers. And for that, you need that visionary leader at the helm.
I love that analogy. It really brings your point home. It reminds us that who's leading a company makes a big difference, especially in a field like technology that's always changing so fast.
It's definitely a factor investors need to consider.
And speaking of considering factors, that brings us to our final thought for today's deep dive. We've covered a lot: trade wars, possible problems in the auto industry, the importance of leadership, and those interesting upcoming earnings reports. But if there's one big idea that ties everything together, it's the importance of being adaptable.
Absolutely. In a world that's becoming more and more shaped by technology and globalization, the only thing that's for sure is that things will change. We're seeing that happening right now with these trade tensions, the digital economy evolving so quickly, and companies always having to come up with new ideas and adjust to stay ahead of the game.
So for you, our listener, here's the question we want to leave you with. In this environment where things are constantly shifting and you never know what's going to happen next, how can you, as an individual or as part of a business, be flexible and resilient enough to not just survive, but really thrive?
That's the key question, isn't it? Because in the end, the people and companies that can adapt, learn, and change will be the ones that succeed over the long term.
It's all about being quick on your feet, being open to new information, and maybe even a little bit brave when faced with uncertainty.
Exactly. Welcome the unknown, question what you think you know, and never stop learning. That's how you navigate these complex waters.
Well said. And that wraps up our deep dive for today. Thanks for joining us as we explore these interesting trends and what's happening in finance and global trade. We hope you came away with some valuable insights and maybe even a few new questions to think about.
And remember, learning is a continuous process. Keep exploring, keep asking questions, and keep diving deeper into the topics that grab your attention.
Until next time, fellow deep divers. So we've covered a lot of ground today. Tariffs, the auto industry, and how NAFTA plays into all of that. Palantir's, that interesting valuation, and even what happens when CEOs decide to move on.
Oh, and don't forget PayPal and Spotify. Their earnings reports are coming up soon.
Right. We almost got sidetracked with all that other stuff.
Okay.
So back to those. What are the key things our listeners should be looking out for when those reports come out?
For PayPal, I'd say watch how those new contracts with merchants are affecting their growth. Are they managing to stay profitable while still expanding? That's the balance they're trying to strike.
Makes sense. And with Spotify, I'm really curious about their subscriber numbers. Are they keeping people on board in this whole competitive streaming world? And what about the details of their deal with Universal Music Group? Has there been any indication yet how that's going to affect their profits?
Those are the big questions. Keeping subscribers happy and managing content costs are the keys to winning in the streaming wars. We'll definitely be taking a close look at those reports.
Sounds good. Well, I think we've given our listeners a lot to think about. Any final thoughts before we wrap up? Besides, keeping an eye on those earnings reports.
Yeah, definitely keep an eye on those. But bigger picture, I think today's deep dive really shows how connected everything is in the financial world. Decisions made in one industry or even in one country can have a ripple effect across the globe.
So it's not enough to just pay attention to your own little piece of the market. You got to understand how it all fits together.
Exactly. Be curious, stay informed, and don't be afraid to ask questions. That's the best way to make sense of this complex, always changing world.
Well said. And on that note, it's time for us to resurface from this deep dive. Thanks for joining us, and we hope you'll join us again for another exploration soon.
Until then, keep diving deeper into the knowledge that interests you.
And happy investing, everyone.